institutional investors are analyzing the space, looking at both public and private companies and where they want to play the energy material supply chain. Is it upstream? Is it midstream? Is it downstream? And they're focusing on two things: contract quality and commodity exposure. And you've seen asset inflation through metals, real estate, equity markets inflation. And most recently, in the last 3 to really 4 months, you've seen stagflation. What you're seeing is continued inflationary commodity price inflation pull. So I think investors need to focus on multiple real assets to hedge out short, intermediate, and potentially longer term inflation in their portfolios.
A warm welcome to viewers catching this session for Assay TV. I'm joining Michael Underhill, CIO at Capital Innovations, an expert on investment policy, portfolio management, and the risk characteristics of real asset investing. So hello, Michael.
Adam, how are you?
I'm good, thank you. Great to be speaking with you today. And particularly at this point in time, it would be good to frame this discussion around the current geopolitical and macro context that we face ourselves. And I'm wondering, how will the Russian invasion of Ukraine and subsequent sanctions that have been enacted upon Russia, particularly on energy and natural resources, how will this impact sentiment for real asset investing?
Well, I think we can agree. That's an excellent question. I think we can all agree that the global puzzle in terms of energy and geopolitical geopolitics, for lack of a better phrase, the puzzle's been just completely blown apart. And I think now you're starting to see factions where there've been sanctions, financial sanctions, other types of sanctions against Russia for its actions in the Ukraine, which are proper and adequate. But Russia's starting to see some of those issues. There are knock-on issues with the price of oil and gas, as Russia's a major player. And I think what you're starting to see is countries independently are looking at their energy solution. They're looking at energy independence and saying, how can I be more energy independent? What's our exposure from a country standpoint? What's our country's exposure to oil and gas, as well as renewables, solar, wind, biomass, as well as things like nuclear? And I think the policymakers in the last few months here, really, Russia ramped up its campaign, late in 2021 in December. A lot of the policy wonks and a lot of the operatives in intelligence agencies said Russia's making a move for Ukraine. It started to happen in January, and you started to see this slow roll that accelerated in the last 30 days. And admittedly, oil and gas has gone parabolic. And as oil and gas prices increase, and you look at the economics structurally behind EV, electric vehicles, as well as solar and wind and biomass, levelized cost of energy has come down. And so renewables are more affordable. So I think a lot of countries, both in OECD, developed markets, as well as non-OECD, emerging markets, are analyzing their energy portfolio, energy independence framework, and saying, how do we re-engineer our puzzle for energy independence? And how can we put together a smaller puzzle with the pieces that we have with our country and maybe some of the other countries that they may have friendly relations with, as well as foreign direct investment?
Yeah, excellent. This energy independence point sort of strikes me as a move towards something that's more based around resource nationalism to a degree. And we're going to see more fragmented energy supply chains, value chains that are, in some respects, encouraging capital to move into domestic projects, for instance, in the US, but also cutting off options, reducing areas where you can place your capital for you, particularly as an asset allocator. You might not be able to invest in those sanctioned energy projects, for instance, that we're in the process.
Yeah, so great question or observation there. I would say yes, absolutely. I think it's, every country, you look at their energy independence. All politics are local, all infrastructure and admittedly the energy independence and energy solution is local, right? Because they have friendly countries, they execute trade deals, but really, what's your natural resource management policy? It's metals, it's mining, it's oil and gas. I look at I look at some of the longer term mega trends And I think decarbonization has been going on for years because renewables are becoming more affordable. And so as a result, you see the increase of investment that's been driven into renewables, both in venture-backed as well as middle market and private equity firms, and some metals and mining focused PE, private equity firms. And then you've seen these companies go public, and whether they're focused on lithium or focused on some of these others, whether they cobalt and other types of, we'll call it metals that are in that energy material supply chain that are helping to solve for EV, battery metals, things like that, right? And even most recently, you saw the London Metals Exchange, what's gone on with nickel, and the inability to trade within a brief period of time, which is, there was a margin call there, and I think you saw, the article that came out by Bloomberg, banks stepped in, created some orderly liquidity, but other than that, the market was seized, and this is something that's occurring intraday. So the LME is, it became very disorderly. And so I think institutional investors are analyzing the space, looking at both public and private companies and where they want to play the energy material supply chain. Is it upstream? Is it midstream? Is it downstream? And they're focusing on two things: contract quality and commodity exposure. The higher the contract quality, the better their enforceable property rights. The commodity exposure, if you have higher commodity exposure, you have a higher volatility pattern, better returns, but with those higher returns come higher risk with the commodity exposure. Conversely, if you want to be lower return, maybe lower risk, you want to play midstream, or if you want to play even lower, more muted returns, downstream. So the upstream high commodity exposure plays, you're going to see wild trading. It's going to be the Wild West for the foreseeable future. And I think you're going to see a lot of sort of speculative trades, but I think you're also going to see a lot of the private equity funds where you're starting to see deal activity pick up and acquiring publicly traded companies that are in the metals and mining space. You look at EV, precious metals, there's a lot of different things, a lot of different ways you can play this.
Yeah, certainly. It's a fascinating space to be into. If you don't mind, we could home into your firm and talk about, some insights on capital innovations. As I understand it, you've some core pillars to the ethos and the structure of your firm. And then maybe we could delve into where does this unfolding energy landscape sit within your portfolios?
Yeah, sure. Adam, I look at this world being an investor over the last 30 years and starting Capital Innovations in 2007. I spent time working for some of the largest household asset management firms in the world: AllianceBernstein, Invesco. I started out at Lehman Brothers in their municipal bond pit back in '92. So I was a fixed income investor, come equity investor, mid '90s, and got into alternative investments late '90s, early 2000s with some of the things that were going on with the tech wreck in 1999, and seeking a way to try and hedge out and deal with some of the volatility post 1999 markets. And so, I've been investing in the real asset markets for over 2 decades. I started Capital Innovations as a sustainable real asset firm, asset manager, to offer both public and private market solutions so we could actually solve problems for institutional investors, whether it be California Public Employees Retirement System, China Investment Corporation, large sovereign wealth funds, even our public market solution. We can solve for high net worth individuals, family offices, maybe some others that are looking for a liquid solution to real assets being defined as infrastructure, real estate, natural resources. And in that natural resources bucket, you have precious metals, industrial metals, agriculture, timber, and other types of natural resource investments.
Excellent. Okay, so given the long-term megatrends that you've mentioned before, how do metals sit within your fund now, or how do you play the energy? The battery metal super cycle, if you like? And you've spoken about some of the sort of forms of capital, whether it's PE or market equities players, how they might navigate the current choppy waters, the volatility. But how do you look at making investments? Are you very bullish on upstream equities, for instance, or is it more of the secure midstream plays that are going to look better in terms of the capital that you look after?
That's a great question. So I look at commodity stocks as being efficient in terms of not only the inflation betas that they provide and the returns they provide for investors, but also you get to the higher margin business in terms of things like lithium. And whether you're talking about investing in the equity in the stock of a company like Albemarle, or if you're looking at a company like SQM, it's the ability to invest in something that's a finite resource with a attractive margin, enforceable property rights contracts to mine lithium. And whether you're in Chile, whether you're other OECD, non-OECD countries, but enforceable property rights, legal enforceable rights to the contract, in which then you have the high quality contract, and then you have the commodity exposure, and ascertaining how much of the commodity exposure we have with a play like an Albemarle or Eskim, and looking at the actual underlying assets, and then modeling the mines, modeling the cash flow, modeling the asset, so we can get a fair value of that stock through a discounted cash flow model, and then be able to assign target prices to that stock. So we're comfortable with entry points as well as target prices for exit points.
Yeah, excellent. You mentioned commodities as a sort of inflation hedge, and that's long term historically been quite a strategy. Also, particularly when we see high inflation like we have now and commodities prices going as crazy as they are now, it harks back to previous economic cycles, which leads to a recession. I just wanted to get your view on, I guess, the Fed moves, what levers they can pull, the inflationary environment we're in, and if this recession question really is going to come to light.
Well, I think I forgive me for saying this, but I think commodities rally at the end of the cycle, not at the beginning. I think we're closer to the end of the cycle than the beginning. And in my opinion, as a quantitative economist, financial investor, but I look at it, the spread, you look at the bond markets, the recession's already started. And we've been in an inflationary regime for well over a year, post-COVID, supply chain shocks, multi-trillion-dollar stimulus package by the U.S. Fed has accelerated that inflationary regime. And you've seen asset inflation through metals, real estate, equity markets inflation. And most recently, in the last 3 to really 4 months, you've seen stagflation, which is more akin to the analog of the 1970s, whereas by definition, stagflation is where inflation accelerates faster than wages, and wages are stagnant. And really, that's what we're seeing, is wages are not accelerating commensurate enough to keep track of that 7% inflationary number that you're seeing. So we're in a stagflationary first inning of a stagflationary environment with a recession pending. And so I see the Fed, they're not going to move 1, 2, 3, 4 hikes. I really think the Fed's going to hit the pause button here. They need to hike. They know they need to. Are they going to hike and accelerate the recession? I think they're just really trying to, in parentheses, hoping for peaceful resolution with Russia and the Ukraine, so they can execute a Fed rate hike and execute a monetary policy in an orderly manner, if you can call monetary policy orderly after the incendiary monetary policies they've been executing over the last decade plus. Again, this is more my personal belief, but I know plenty of Fed watchers as well as economists, and I look at the Fed. They should have. I'm Monday morning quarterbacking it. They should have hiked rates years ago. Even if they would have done 12.5 basis point rate hikes quarterly, it would have been an easier adjustment, because now they're really backed into a corner. We have a recession that's a few months into the making. Now we're seeing stagflation really taking hold. Do they really want to hike and cause a tailspin? Where, particularly if I look at something like the U.S. consumer, 64% of the U.S. Taxpayers are living paycheck to paycheck. I'll repeat that: 64% of U.S. taxpayers are living paycheck to paycheck. So if the Fed hikes rates, that causes that monetary policy shock, policy error, creates an acceleration of the recessionary regime. I think that's really, you get that policy error, you're going to start to see a significant tailspin in the U.S. economy.
Yeah. So it's a question of when they're going to be prepared to do this. It's interesting.
Yes.
Let's move on to the sustainability elements, because I want to try and tie that into with where we're heading on the macro and economic backdrop that we've described. Is it going to hurt sustainability in the long run? Is it going to hurt ESG credentials? Is it going to be a case of, compromising on these for energy security, moving back to hydrocarbons, for instance, or looking for monetary gain at the compromise of sustainability and ESG because of the difficult prevailing circumstances?
Well, another great question, Adam. And the insight I would bring to this is, and I would say, the solution's not too far left and it's not too far right. The solution's somewhere in the middle, where a country, a region can execute their energy independence and execute policy, discharge their duties, so that they're going to use in an efficient manner oil and gas and renewables as we're solving for that longer term hydrogen, blue-green hydrogen solution. And it's going to take a decade. We're starting to see companies that are in that hydrogen space. It's not economical. It's not efficient. We're still 5 to 10 years plus out with hydrogen, which is really a game changer. So I think you're going to see, as a source of fuels, countries will still be reliant on oil and gas, as well as renewables, as well as nuclear, to try and solve their energy independence puzzle. The conflict, the war, really, what's going on with Russia and Ukraine, is accelerating the conversation, and it's gone from a back burner issue to a front burner issue. It's now effectively brought the policy discussion to the dinner table, and now everybody's talking it globally, trying to figure out, how do we address our energy security? How do we address our energy independence? In terms of ESG and sustainability, when you look at it on its face, sustainability is about one thing: doing more with less, reducing your waste. And ESG specifically, environmental focus, socially responsible investing focus, and governance focus. Part of the social and governance is keeping your country out of war. Part of the social and governance is protecting your stakeholders, your constituents, and really trying to discharge, as a politician, as a leader of a country, trying to discharge your duties and minimize conflict like that. And I think the environmental impact, I think the wide pendulum swings to the left, the wide pendulum swings to the right, whether you're conservative, liberal, moderate, somewhere, the solution's always somewhere in between. It's a little bit of oil and gas, it's a little bit of renewables, it's a little bit of nuclear. I think it's going to be a little bit of everything. And it's going to be nuanced by countries, because clearly you look at Great Britain, you look at other European countries, they're sourcing their energy source from gas, and the gas is coming from Russia. So now they're rethinking nuclear policy, they're rethinking coal, they're rethinking things like oil and gas, which 6 months ago were massive, aggressive decarbonization was on the docket. That being said, you've seen the EU. One of the officials from the EU came out and said, we're going to accelerate renewables. And this is all the more reason to accelerate renewables, to decarbonize and hedge out that Russian bear risk, that reliance on Russian natural gas. That's one way to do it. But what I would say is, I would press that EU official, I'd press her and say, so show me your nuanced policy that's not going to significantly increase prices and create what's in industry nomenclature is called greenflation. In other words, the massive left pendulum swing to say, we're going to do this in a broad sweeping policy manner. Be careful of whenever a politician comes in and offers a guaranteed solution, because I can tell you it's going to be costly and it's going to be inefficient. And that's just my experience I've seen.
Yeah, certainly. And if you think about the raw material inputs, the actual supply side, life of mine versus time to develop new mines, bring these materials online, there's clearly a supply side shortage if we're thinking of switching as quickly as we are.
Yeah, and think about the acceleration, that greenflation, the demand side pull for metals, demand side pull for EV supplies, energy materials, and that acceleration, that'll be the definition of commodity price inflation for lithium and cobalt and other. And if you look at solar, copper, some of these other metals, industrial metals, copper is one of the biggest that goes into solar. There's going to be inflation, commodity price inflation there from demand side pull, even more scarcity of it. And structurally, we're in a 5-year shortage of copper. So you're going to see copper is it will continually increase in price. So I think what you're seeing is continued inflationary commodity price inflation pull. So I think investors need to focus on multiple real assets to hedge out short, intermediate, and potentially longer term inflation in their portfolios.
Yep, excellent. Okay, I want to draw on the capital allocation elements linked to what's going on in the ESG space, particularly around the data convergence project, of which I know you're a signatory and a proponent. What does this really mean for firstly capital innovations, but also the GPs and LPs who have signed up to this? What are the innovations that are going on there that's led by the industry in terms of changing the way that capital is going to be allocated?
I think the easy way to respond to that is one cannot manage what one cannot measure. And the Global ESG Data Convergence Project, which is led by California Public Employees Retirement System, CalPERS, and the Carlyle Group, as well as Capital Innovations and others, there's roughly about 110 global signatories representing north of $4 trillion in assets, in which we're focused on committing our data on private markets to solve for that. First, you need to get the data. Then you need to harvest and aggregate and scrub the data to identify best practices for GPs and LPs of private funds. And so that ESG Data Convergence Project is a multi-year global initiative, similar to when we were a signatory of the UNPRI in 2007, Capital Innovations, when that UNPRI was being formed and working with the infrastructure workstream as chairman of the infrastructure workstream for the UNPRI, we built a global investment compendium for infrastructure. Fast forward to 2021, September 2021, this is the ESG Data Convergence Project. We're narrowing the scope, focusing on private markets. It's not just infrastructure, it's globally. And they've picked specialists for GPs and LPs for certain areas, sectors, to focus on data gathering as well as committing data from the investments that we're making. So we can talk about ESG, we can talk about front office, middle office, back office issues, as well as things like the labor industrial policies and take ESG down to a granular level. So then we can report better, inform our investors better, and GPs and LPs can more easily exchange data and then benchmark best practices for ESG across venture, private equity, real assets, other types of investments.
Excellent. And just to sort of throw something out there, typically these initiatives can, through setting them up, slow down the capital allocation process. Do you see this initially doing that? Do you see this becoming a force for accelerating the way that capital can get deployed into some of the projects that we've spoken about?
So I see this as a marathon, not a sprint. And it's going to be a long protract. And if you've run a marathon, if you run a 10-minute mile pace, you finish in 4 hours and 21 minutes roughly. Conversely, if you quicken your pace to 9-minute miles, you're going to run it just a touch under 4 hours, sort of 357, 358. And then if you run an 8-minute mile, you're going to be somewhere like about 3 hours and 40, 342, somewhere around that bandwidth. So I think the ESG Data Convergence Project is a marathon, not a sprint, in which it will take time and intensity and wisdom, wealth, and work of everyone at the table to contribute data and work together. But I think we start out with a 10-minute mile, and I think will accelerate our pace as we learn more about the people that we're working with, as this is a collective, a group of people, some of which have worked together, some of which have not on a global level, and of which there'll be reporting gaps, informational gaps, and people and process and philosophy. And so I think it's going to take time for the project, as it always does. It did the UNPRI over a decade ago when we did that. But I think it's something that we can move the ball forward and be consistent and really show managing and measuring with better use of data. And so I think the Latin phrase that's always been used is gesta non verba, right? Deeds, not words. You want to be able to lead with how you act, your deeds, and less your words, which we've seen a preponderance of managers that are using their words in greenwashing, and they have no measurable impact, no measurable metric of which they can benchmark their ESG investments, whether it be private markets or even public markets.
Very good. I just wanted to end on a geopolitical sort of note. but to get your views really around where the US stands to lead this decade in terms of certain industries, particularly ones that you might cover. I want to ask this question in the context of China and Russia's more recent closer ties, and then also the fact that China owns such a great deal of the midstream and downstream capacity for production of heavy industrials, refining capacity, for instance, from everything from stainless steel to the lithium that we've been speaking about. The US has always been a leader, one of the global leaders in terms of energy and energy production. But where do you see the US leading this decade within that broad scope, if you can?
Yeah, I think that's a great question, Adam. And clearly you've done your research, your homework. I think the future, if you look at where the US has been in terms of its energy as an energy producer, one of the leading energy producers, we've provided oil, but also gas on a global level. And I think the pattern of extraction of natural gas will accelerate, because I think the phrase, that a lot of the energy investors have focused on is the US is the Saudi Arabia of natural gas. And I think when you look at that, the preponderance, I think we have 4,000 years of supply of natural gas here in the US underneath our feet. And so there's a preponderance of it. So we not only can use it here, but ship it, net export it via LNG, compressed liquid natural gas. We've been doing it for Japan. We've been doing it for Europe. And I think that pace will accelerate over the next decade in terms of leadership in nat gas, as well as the application of technology in hydrogen. And so I think nat gas and hydrogen are the logical game changers for the energy material supply chain in the US, and how they're going to lean into their core competencies.
Excellent. Fantastic. Michael, that's been really enlightening getting your views here and getting some insights into the firm and also the state of play across capital allocation and real assets as well. So thanks very much for speaking with Assay TV today.
No, that's my pleasure, Adam. It's been a pleasure. Thank you very much.